Good morning and welcome to another edition of the Main Management Weekly Market Note. This is July 25th, 2025. As usual, I'm Alex Varner, head of research, alongside
James Maxwell, VP of Research.
Let's get into it. I think this week was fairly light on the kind of macro data front, a lot of housing stuff, but on the performance here, you can see weekly healthcare actually led the way up 3.5%, which was its strongest week of the year. That sector has kind of struggled this year. But I think on the back of Eli Lilly earnings and a couple other good reports, it had a strong week. So maybe signs of life there.
Yep.
We shall see. On the recession dashboard, we updated one of these. We changed employment to blue from red, just kind of looking forward. The picture is going to kind of moderate, I think, is the general rule of thought there.
Also, the PMI side from blue to green now. Similar idea. You're kind of seeing, especially on the services side, we'll talk about this more, but some inflection upwards in that area.
Yep, exactly. One of the bigger data points this week was durable goods orders, which fell 9.3%. That kind of unwound the big jump we saw in May off of transports. Again, I think there's a big aircraft order. The drop was less bad than forecasted, but it's still the biggest since April of 2020. You've seen some noise here, especially with the tariffs and the kind of pull forward of orders and companies trying to manage around that. But transport equipment was down 22. Non-defense aircraft down 52, capital goods down 22 as well. The core capital goods, which is a business spending proxy, it's non-defense capital goods, was down 0.7, so a little bit more modest decline, but it did miss expectations for a 0.2% increase. Transports were up 0.3, and then on a year over year, all of them decelerated, but they are basically all positive from a year over year.
I was going to ask, looking clearly, this is something that's affected by tariffs. You can even see on the left there, those blue bars just going whipsawing back and forth, and kind of these one-off aircraft orders and the like. Are you looking at like year over year as a way to look at the kind of a longer term trend line, or is there anything else that you look at that's more of like that core trend line?
I think that year over year probably, especially when you take out the transports, because those can be so volatile because they're big one time, kind of rare, or not rare, but not frequent orders. And so I think looking at that kind of overall year over year trend, which bottomed negative back in, mid 2023 and been kind of trending higher, that's a good thing. And then, we don't show it, but I think on an absolute basis, the dollar amounts are elevated. They're all pretty elevated relative to history. So again, the dollar amount spending is solid there as well. We also got existing home sales. This is nothing new here. Last couple of years since they raised rates, really, since the Fed raised rates in 22, existing home sales have been unable to get out of their own way. They slowed to 3.93 million units, missing 4 million estimated. They're flat from a year ago, but again, that's on basically easy comps. And as you can see, they're pretty depressed relative to historical levels. And then on top of as if 7% mortgage rates weren't enough, you've got historically high prices. The median price jumped to a new all-time high at $435,300. That's up 2% year over year. Basically, homeowners are just saying, you really need to incentivize me to get out of my house if I'm going to go put down payment and pay 7% mortgage.
If you look at that left-hand chart, you kind of see it's been range-bound post-Fed hiking cycle for the past basically 2 years. Hasn't really moved anywhere.
Yeah, it's just a tough market.
Yeah.
On the inventory and supply side, again, you can see the inventories are building. They ticked down this month, but it's the first decline in 6 months, and they're kind of trending upwards. They're up 16% from a year ago. And that May reading was the highest since June of 2020. So those are starting to build back. And then you're seeing also homes sitting on the market longer. The month supply hit 4.7 months. It's back above its median, basically. And that's the highest since July of 2016. So that's, people are they're putting their houses on the market, and they're just kind of sitting there because people aren't willing to pay up for them. We also see this in new home sales is very similar dynamic. Again, those ticked up to 627,000 units, but fell short of expectations for 650,000. They're down basically 7% year over year. Again, high rates, high prices hurting them. The number of new homes for sale continues to rise. That hit 511 units, which is the most since October of 2007. heading into the great financial crisis. That's up 8.5% year over year. And again, high rates and prices sitting as affordability remains a challenge. That's why these, people are putting these homes on the market, or I guess home builders are putting the new homes on the markets, and people aren't biting. For the prices, you've actually seen some moderation in prices for the new homes, not existing, but new homes here for the last couple of years. They've been kind of topping out to actually declining. The median new home price is now at just over 400,000. That's down 13% from the peak in October of 22. So you are getting some relief here. And the average price is down to 500K, which is 7% off its July 2022 high. But again, they're still pretty elevated, as you can see on the right there. And they've really accelerated kind of coming out of COVID as the demand for homes just kind of skyrocketed as people wanted to get out of cities and buy a home in the suburbs, essentially. And then similar to existing homes, new homes are sitting on the market longer, basically double the median of 5.9 months. They're up at 9.8 months, and that's the highest since September of 22. But if you go past that kind of COVID spike, you go back again basically to the great financial crisis for how long these houses are sitting on the market.
Yeah, it seems like the home builders are building out these homes, and then obviously the inventories are building, month supply is building. They can't sell them at the prices they were hoping for, so maybe they're cutting those prices or keeping them more stable, offering incentives. I know that's another.
And they've also been building smaller homes as well to kind of keep the price down. So as opposed to 3,000-4,000 square feet, they're building 1,500-2,000 square feet, which helps on the pricing as well. So there are a few other dynamics at play there. But looking at kind of the total housing market as a whole, when we add new and existing homes basically make up 80, 85, 87% on a dollar basis. When you take the number of homes sold and multiply that by the median price, then you get the total value of all homes sold, and that ticked down to 1.96 trillion. Existing homes make up 1.71 trillion of that, so that's 87% there. That kind of dwarfs the new homes, which are a quarter of a trillion. But that, again, that dollar figure on the total value of all homes sold has been range bound since rates jumped in 22. It's flat year over year at 0.4. And it's worth noting this thing's down 25% from the peak in November of 21, which was 2.63 trillion. So that's a pretty big drop off in the kind of total value of homes sold on that housing market. And on the right, if you add new and existing home supply, month supply together, you're at 14.5, which is the most, the highest since August of 2011. And that's up 17% year over year. So you're seeing these houses just kind of sitting there for over a year here. You've got, and month supply, for those who don't know, is basically what it would take at the current rate of purchasing, how long that would take to basically get to zero for all the houses to sell. So that's been, again, the dynamic we touched on, but tough housing market. We got the flash PMIs, shifting gears here. As Jane mentioned a little bit earlier, the manufacturing figures are mostly higher. U.S. disappointed at the downside, falling back into contraction at 49.5. That's the lowest since December of 2024. But we are seeing some signs of life in Europe, which is good. But still, most of those numbers remain in contraction, even if but you got to start somewhere, and you're starting to see these lift a little bit.
On the services side, just to touch on this, the U.S. rose to, I think, 55.2. One of the things that I was reading was from the S&P Global Chief Economist. So, the report, the producer of this report was talking about how that implied a 2.3% GDP number for Q3 ahead of what was in Q2, which was 1.3% implied. So clearly, even though manufacturing has moved into contraction, services is a large part of that of the U.S. economy, and that moving higher bodes well for kind of the broader GDP number.
Yeah, I think that the manufacturing sector is like 11 or 12% in the U.S. So it's despite it kind of getting more view on the headlines. The service sector is definitely what drives, and you see that also plays through the composite numbers. We don't show those here, but the composite numbers basically go the way the services do for almost all these economies because
it's weighted so highly.
As a dominant sector. So that's kind of, as we mentioned, a lighter data week. This coming week is big. We get core PCE. That's the big Fed's preferred inflation number. We get non-farm payrolls. We get Q2 GDP, a first estimate there. We get some wholesale inventory numbers. So this is kind of a jam-packed week coming up.
And also the FOMC will be having their press conference and announcement on Wednesday. It's expected that they don't cut this time. Currently, if you're looking at kind of the Fed Fund futures market. Expected to cut maybe in September, if not then October, and then a second cut is expected in December. I think a lot of this meeting's press conference by Powell and the Q&A afterwards will be watched to see if that September cut is still on the table. But clearly the Fed is in a tough spot here, both from political outside pressures and also just looking at the economy. There's kind of this underlying potential weakness in a lot of the labor market, but it's not really cracked yet.
Yeah.
And then looking at things like PMIs, look solid, imply a pretty strong economy. Inflation continues to kind of steadily come along 2.5%.
Yep.
Expected to potentially rise with tariffs, but that's again another thing that's not really been shown come to fruition yet. So a tough spot for them to be in.
Yeah. I'm glad I'm not on not on that committee.
Yeah.
So to summarize, quickly again, durable goods orders dropped, driven by transports. Existing home sales, new home sales, total housing market just remains kind of locked.
Yeah.
I think maybe you'll see some relief if the Fed starts to cut later in this year. I think you'd like to see mortgage rates get down below 6, and I think that will kind of free up some of the buyer help the affordability there with these high prices. And then the flash PMI is starting to show signs of life.
Yep.
We get the final ones at the end of this week. So we'll keep an eye on those. But again, this big data week with JOLTS, ADP numbers, GDP, Core PCE, non-farm payrolls kind of topping it all off. So a lot of data coming out this week in tandem with that Fed meeting. So yeah,
should be an exciting one.
It'll be a good one. But that's about it for us. Thank you for joining us again. We're signing off now. Take care.
Thanks.